in rural India. While the current pandemic-induced lockdown has impacted us and may continue to do so in the first half of FY22, we continue to remain positive about the long-term prospects of the market opportunity and the business. With this, I would like to hand over the conversation to our CFO, Rumit. He can update you about the financials for the quarter, post which we can take questions.
Thanks, Tash. Good evening, everyone. Moving on with the financial highlights for the quarter ended Q4FY21. Our consolidated revenues for the current quarter stood at 183.9 million against 85.1 million in the corresponding quarter, a jump of 116% year-on-year. EBITDA losses for the current quarter were reduced to 40.2 million as against an EBITDA loss of 55 million in Q4 of FY20. This is despite us taking a management overlay of 34 million in our legacy book in the quarter and the ESOP charge for the quarter. The reported non-GAAP PBT stood at negative 40.7 million in Q4 FY21 as against a non-GAAP PBT loss of 61.1 million in the last corresponding quarter. ESOP charge for the quarter was at 15.2 million against 5.9 million in the last corresponding quarter. On a full year basis, we crossed an important milestone where our consolidated revenues increased by 80.5% to 506.3 million as against 280.5 million last year. Again, this was impacted by the management overlay, due to which our EBITDA was negative 20 million as compared to negative 202.6 million last year. And our full year non-GAAP PBT was at negative 39.1 million in comparison to negative 207.6 million for the prior year. Our ESOP charge was for the full year at 33.4 million as against 38.9 million last year. In our credit business, our outstanding loans and advances for the current quarter was at 455 million, down 64%. This is in line with our articulated thesis of exiting credit-led customer acquisition. Further, I would like to give some context to the management overlay that has been taken in Q4 FY21. We all know the impact of second wave of COVID-19 that has been there in India, and small businesses continue to remain most impacted. These management overlays are based the ongoing situation and what we foresee as potential challenges in FY22, given the impact of second wave and the ongoing lockdowns. Over the past 1 year, we have been aggressively de-risking the balance sheet, and with this charge of the management overlay, we feel comfortable with our provisioning levels. We remain a zero debt and a net cash balance sheet, and our cash position on hand has improved to 155.9 million as of March 31, 2021. Moving on to the platform metrics, despite a tough external environment for India's and MSMEs, our core metrics have been performing well. This is our strategy to aggressively expand distribution for greater market access. We are happy to report that in our rural tech platform, the retailer count has increased by 143% year on year to 131,082. Of this, 27,826 retailers were just added in Q4 FY21 alone. The rural tech platform gross transaction value stood at 57.5 billion rupees in FY21 as against 39.3 billion in FY20, up 46%. The revenue growth in this segment has been tracking ahead of the GTV growth, led by our expanding product stack in the rural tech business. On our Niyogin Urban Tech Partners platform, the partner count increased by over 100% and stood at 4,017. Retail channel urban activation rate for the full year was at 19%. This is despite us not having an on-balance sheet product, and as you all know, we have transformed this to a fee-centric platform. With this, Diwakar, we can open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and one at this time. The first question is from the line of Bhavik Mehta from Roots Ventures. Please go ahead.
Yeah. So, like two questions. My first question was, what is the current loan book outstanding from the legacy book, which we are continuously trickling down?
So, Bhavik, as Dash had mentioned in his opening remarks, we've just started the transaction-led credit business in a pilot phase in Q4. So the iServio acquisition was consolidated in December, and this transaction-led credit product has started in Q4. So the impact of this on the aggregate loan book is not material. So bulk of the loan book is legacy. Okay.
And so, is there a timeline in mind that the entire loan book would not appear, or what is the strategy for trickling it down, or if there is any strategy for that?
Yeah, Bhavik. So if you look at it, we have been aggressively ramping down the legacy loan book, right? It has come down by 64% this year. And I think beginning of FY21 itself, we stopped adding more exposure on the balance sheet. So if you look at it, most of these loans were built during FY19 and primarily FY20, with on an average duration of about 21 to 22 months. So given that we've not taken anything in FY21, you can assume that by bulk of this would be completed or run down this year. This financial year.
Okay. And any additional amount to be provided on this or on the subsequent quarters that you expect?
So Bhavik, look, like I mentioned, we've been reasonably conservative and upfront in terms of the current challenges that are there in the current operating environment. As you know, the operating environment is extremely dynamic. At this point in time, I can say that we feel comfortable with the kind of management overlays that we have taken, but very hard to predict how the external environment shapes up, right? So I would suffice to say that we've recognized some of the challenges that we could see in FY22, and in response to those challenges, we've already taken the management overlay, and we feel comfortable at where we are.
Okay. So, and my next question is around slide 25 of your presentation, wherein you mention M&A and growth as two different parameters for your three verticals. So, if you could just explain what exactly does that mean?
Sorry, Bhavik. So you are, if I understand your question correctly, you are asking us about the M&A strategy?
Yeah, so slide 25, you mentioned M&A and future outlook as two separate pieces. And for all three, you mentioned, say, product scale, product market access, rural, including via new bank model. What exactly does this mean?
Yeah, so I think, I think what we are trying to communicate here, Bhavik, is that what is going to be driving our M&A strategy in each of these verticals, right? So if I look at rural tech, I think two specific areas that are going to drive our M&A is going to be around product. If we can, how we can look at expanding our product stack in that market. And second is going to be around scale, right? So if there are any attractive consolidation opportunities that we may get to scale that business aggressively, we will look at that, right? So on credit side, as you can see, we will look at, there are a lot of interesting platforms, and our thought process here again is that credit M&A, if at all, is going to be led by expansion of market access and any interesting product stack that we can build to dovetail into what we are building on the rural tech side, right? And again, similarly on the wealth tech, it is going to be product led and scale led, right? So the idea is to give everybody a flavor in terms of how we dimension the M&A that we look at across these three business segments. Dash, do you want to add?
Yeah, I would just want to add, we discussed this in the previous call also, where we had articulated our M&A strategy. Right, the M&A strategy, we are a MSME focused entity, right? We provide solutions to the MSME, and all our work that we do, the product set that we have, the distribution that we've built is all focused on the MSME. So I think our focus on M&A is again driven only by two strategies. Either we increase our product stack on something that we don't want to build faster, go to market by buying in the market, or the other is to improve our distribution and therefore increase our scale by being more impactful on the ground. So I think these are the two main strategies on which we are pursuing all the M&A discussions that will happen now or later.
Sure. So currently the balance sheet has, I think, around 100 crore of cash at present, right? So my idea of asking this question was that what would this, so I also see that the lending would be through partners and also on balance sheet. So is there a segmentation of what amount of book are we trying to create on balance sheet and what is through other partners and what is the M&A piece of this? Because currently the cash in itself is, I think, 100 crores. If it's not, then that's what my understanding is. Yeah.
So, Bhavik, it's not that we have a certain allocated amount segregated for M&A. And historically, if you look at our M&As, they have been cash plus stock deals. So there is no separate segregated amount that we've carved out from our cash balances for M&A.
Yeah, I think as we mentioned earlier, we are working on this transaction-led credit proposition with our own platform users, right? So and like we mentioned in my opening remarks, this is a test case that we are doing. I guess in the next couple of quarters, we'll also get a sense on what is the size of book we can build where we are comfortable. So all that will flow in. I don't think we've allocated any capital specifically for M&A that we've kept aside. So we are managing this capital, we think, efficiently in terms of investing and making sure that we get a decent return. But this money will get utilized for business purposes, either through M&A or to keep building the transaction-led credit book.
Sure. And my last question is around, so given that revenue is more of an evolving piece over the past 2-3 years, so what are the top 3 metrics that someone would need to track with respect to Niyogin to measure the success of the company?
So I think, again, to me, the success of this company is driven by the distribution reach that we have. And that's why we articulated the expansion of our distribution reach in the initial comments. When we talk about rural touchpoints hitting 130,000 touchpoints, we talk about urban, partner touchpoints touching 4,000. I think that to me is the first and most important criteria. Number 2 is the activation rate on these touchpoints, on how we are able to continuously increase activation rates on people who are using our platform and adopting our platform. I think these are the 2 important data. And then third, obviously, is the level of transactions that are going through our platform, which again translate into revenue numbers. So I think these are the 3 points I would tell you to track us on a active basis.
Sure. I'll get back in the queue.
Thank you.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good evening, sir. Thanks for the opportunity. Taking forward from the discussion with the previous participant, so just want to understand on the M&A side, and also in the opening comment you had mentioned that we are looking to add certain products to benefit from the distribution reach that we are creating. So in addition to the products that we are already offering, are there any new products that are under consideration to be launched in the next 1.5 years?
So I think there are multitude of ideas that we are focusing on. I think I mentioned that we've just launched Aadhaar Pay on our rural tech platform. Obviously, we need to see adoption of that platform. But that platform is live. We've also launched microinsurance on both our urban and rural platforms. So incrementally, our strategy is twofold, right? One is to continue to focus on adoption of the products we launch, and then based on market feedback and where we think there is opportunity, we will continue keep adding to the product stack that we have.
Right. So in terms of understanding, say, the profitability from the channel, like, because that will be one of the key criteria to measure in terms of how many channel partners are getting activated. Any color on, say, from a 3-year-old vintage channel partners, how has been the revenue profile or profitability pool or something like that? Or 2 years old. So some vintage-based analysis if you could share on how the partnerships have progressed.
So Rohan, look, I think one on the rural tech side, generally our model is a partnership-led model. That is why if you look at fundamentally our cost structure is reasonably variabilized, and as a result, this channel per se is profitable. However, we have to see it in context with the investments that we are making. Obviously, it's an extremely large market that we are operating in, and just the addressable market of the 2 or 3 transaction products that we have is about $6 billion, right? So we are obviously a small market share in terms of the overall opportunity. So obviously we continue to make investments. So from a profitability perspective, given our approach of cost efficient market access, and a variabilized cost structure of the P&L, this is always going to be high on profitability.
Sure. And any thoughts on evaluating the co-lending opportunity? Because some fintechs have been doing that right now. Obviously, we had scaled down the lending operations to conserve capital and move to more fee-based income profile. But just want to check in case there is anything on the consideration on the co-lending side.
Like I said, our balance sheet we are now deploying largely towards our own platform users, right? So when you have 130,000 retailers on your iServeYou platform, right? I think I want to use our capital largely for making sure that we are able to provide that. The good part about that strategy, the way we think about it, is that there is a multiplier effect. Because when you provide working capital to these retailers, right, effectively the payment volumes also increase, because the money gets used to transact more payments through our network. So we're trying to use our capital in ways by which we can get a bigger bang for the buck, rather than just looking at return that we can get in terms of interest income from that capital alone. So the capital is being deployed there, and that is really our focus area on how we want the capital to be efficiently used.
Sure. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Sankar from Seraphic. Please go ahead.
Good evening. I have not been exposed to the company, so this is my first call. So I just want to understand a little bit.
Sorry to interrupt, Sankar. We are not able to hear you clearly, sir.
Is it better now?
Yes, sir.
No, I'm using the handset only. Is it better?
Yes, sir. Please go ahead.
Yeah. So since I'm new to this company, I just wanted to understand, on the business model. So you say that you have a platform. So if you can just make us understand, on the revenue model side. So the presentation talks about, the different platforms that you've created, particularly the, iServeYou platform. So if you can just make us understand, how does the, the breakup of your revenues, the 50 crores that you've shown in the current year. Can you just give us a broad breakup of, how much of that is commission, how much is license fee, how much is, so just to give us an understanding about and how it has grown over the last couple of years.
Yeah. So look, I think in our presentation we've detailed out the revenue drivers for each of our segments, right? And as you can see, if I look at the rural tech, bulk of it is fee or commission led. Our credit platform, especially on the urban tech side, is now a fee-centric business model. And obviously the wealth piece is also a commission or a fee-centric business model. So in terms of bulk of the revenue drivers are commission or fee-centric. In terms of the revenue mix, I would say we've not broken that out separately, but I would say that bulk of it, as you can see, will come from the fee business. So I think greater than 50%, if I have to put a number, greater than 50% is going to be fee-led.
No, in terms of rural versus urban versus tech, if you can just give the breakup.
So rural is the bigger part of our business. That's the larger part of our business. I mean, you can see the difference in the Consolidated Chapter.
So that is basically what you get from your rural partner in terms of the fee that you get in terms of providing the platform.
I think the rural business, as we've detailed out, there are multiple products, and the payment that we get is not necessarily from the rural partner, right? There is services that we are providing to banks. So there is a commission that gets paid by the banks. In the domestic money transfer, the person who's initiating the transfer pays a commission to the rural partner, and that commission gets shared. So there are multiple models depending on the product on how the commission gets originated and how it gets shared between the channels.
So in terms of transactions, how many transactions are there? If you can just give us an understanding of that.
So look, the average ticket size across products is different. So we've given the GTV, but you can say the average ticket size would vary between 1,800 to 2,700 rupees.
Okay. And what do you get paid for each transaction, approximately?
Sorry, what is the question?
So based on the transaction value, what is it that you get as commission? Just to understand revenue model.
So again, this varies depending on the product. So if you look at our transaction-led products, which is TMT, there is AEPS, and there is micro ATM, the spreads vary between 40 bips to 100 bips.
Okay, I'll get back with you.
Thank you.
Thank you. The next question is from the line of Ashish Kacholia from Lucky Investment. Please go ahead.
Yeah, good evening to the team, and congratulations. Hi, and congratulations on a good set of numbers. My question is, what is the order of magnitude that we are looking to grow in the next 2-3 years?
So I think I don't think we've given out a direction or guidance on the number that we want to grow. Obviously, we want to grow in leaps and bounds. We think the market opportunity, and just to give a sense on the rural side, Rumit alluded to the market opportunity. Today, the market opportunity just on DMT and AEPS, which is Aadhaar-enabled payments, is over $56 billion. And if you look at our GTV, right, we are shy of $1 billion. So there's a huge opportunity sitting out there that we need to sort of make sure. And this business is growing, right? It's not a static market opportunity. AEPS itself has been growing at a run rate of almost 90-95% CAGR. So it's growing pretty rapidly. So therefore, our expectation is that we need to keep expanding. DMT is not growing at that rate. It's at a lower rate, but it still is growing. So the focus is to keep expanding the network, keep increasing the throughputs, right? And the way to increase throughputs is to keep adding incremental products, increase stickiness, and to increase activation rate. So there are multiple sort of levers that we are playing upon, and we want to demonstrate significant growth rates. Ashish, we haven't really given out a guidance on what we think the next year or the following year would sort of deliver.
Okay, thanks. And my second question is, in the markets that we are playing in and versus the other players, how are we doing on the market share front? Are we gaining market share, holding on, increasing? Any sense on that?
So I think market share has been steady. The reality of the situation is the last couple of months, if you've seen with the lockdown coming through, right, DMT volumes have obviously come down across the board. a lot of the TMT volumes were really migrant laborers sending money back to their families, from the locations they came from. With the lockdown, those volumes do go down. And Aadhaar-enabled payments volumes are steady because people do want to withdraw cash. So that sort of continues to give us some positive sort of upside. I think market share, in my view, the way we calculate as a percentage from the data that we get from AEPS, etc., I think we are pretty much on a stable footprint. But what happens also, I would argue, is that the full value of a new network that we've created, it takes a quarter to come through. So this quarter we added about 28,000 new retailers, right? The value of those new retailers will come through in the coming quarters. And that's where you'll see a significant jump in the market share coming through as volumes come in from those new retailers.
Okay. And my final question is, any thoughts on where we would be playing in the system versus the larger players such as Pine Labs, and we see a lot of these big fintech names kind of talking in terms of billions and trillions of rupees and dollars, whatever. So, any sense on where we are going to be playing in the market versus some of these larger names?
So I think we are operating in slightly different verticals today. Of course, in the final analysis, who knows whether the verticals will converge or not. But right now we are operating, a large part of our business is on the rural side. I don't think Pine Labs has a significant presence in the rural side. They are really the market leaders and the front runners on the POS business and on the BNPL business, which is the Buy Now Pay Later program, which I think is very good. We are operating on the rural side, and our products are more driven by looking at cash to digital and digital to cash solutions. We've also launched a digital solution in terms of Aadhaar Pay. And to the best of my knowledge, Pine Labs is largely on the digital play. So we are operating in slightly different markets, and the space is quite large. Obviously, they've done exceedingly well. I think we think our runway is quite substantial where we are operating.
Right. Thank you, Tan, and all the very best.
Thanks, Ashish.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of VP Rajesh from Banyan Capital. Please go ahead.
Hi, Tash. One question on this balance sheet on slide 31. So your loan book is 45 crores and change. And if I heard your earlier comments, it will be completely wound down by the end of this year. Is that right?
Hey, Rajesh. Firstly, hope you're doing well.
Yeah, all well. All good.
Great. So I think the plan is that a majority of this balance sheet is anyway a legacy balance sheet, so it will be wound down. It will get replaced by a transaction-led, depending on how our experiments play out in terms of providing capital to our own network, our platform-led, players. So some of the loan book will get replaced by that. I don't want to give you a number today on what that number would be because we've just started this process in the fourth quarter, in the quarter that's just gone by. And so far our results have been fairly encouraging of the work that we've done. Right? It's been a very small sort of experiment with about 50, 60 customers that we work with. So as we expand, I think you will see a faster depletion of the loan book in the next couple of quarters, and then the build-out will start coming in.
Okay. But, I mean, of this 45 crore just as of today, would it be fair to say that 90-95% of it is legacy book, which will be gone like over a year, right? That's the way to think about it.
I would think that's a fair statement, Rajesh.
Okay. And on the P&L side, if it were not for the ESOP charges or this ECL charges, you would be profitable, right? Just looking at the numbers. I just want to make sure I have a basic understanding of your P&L.
Yeah. Rohit, you want to?
Yeah, that's right. That's right, Rajesh.
Okay. The next question is if you go back to your slide 26, I have a couple of questions on this. So one is I don't see the CA thing that you had talked about on your previous call. So have we put it on the back burner? That's question number one.
So, sorry, what was that? I missed the word.
The platform that you were creating for CAs. So so that they became a feeder for your leads on the MSME side?
Yeah, so that continues. That's the urban tech part that we talk about. When we spoke about the 4,000 partners, those are really the financial intermediaries, chartered accountants, loosely put. So that continues, and it's there in the presentation, and I think we are focusing on that as well. The rural tech part is obviously a bigger part in terms of a contributor to revenue, so we were focusing in this discussion more on the rural side. But it's very much there in our presentation.
Okay. And then my second question is, if I were to split your 18 crores of revenue in Q4 into these 4 baskets, rural tech, urban tech, credit, wealth tech, what will be the split of that?
So Rajesh, I would say about 70-75% of the revenue, right? You're referring specifically to Q4, is really coming from the rural tech business.
Oh, really? So the credit portion is very small in this Q4, is it?
That's right.
Okay. And how much would the wealth tech be?
So wealth tech is really small. So I would say about 70-75% will be about rural tech. About 2 to 3% would be wealth tech.
Okay, and credit will be probably the second largest piece of that pie, right? Is that correct?
Credit will be the second largest.
Yeah, that's right. Yeah. So in order of magnitude, it is rural tech, then credit, and then wealth tech.
Okay. And then my following question is that, if you think about 3 years down the road or 5 years down the road, will these splits change, whether credit will become bigger portion? How do you think about the business, as you chalk out the strategy?
So Rajesh, I think it's difficult to project what life will be 3 years down the line, especially since we are also M&A hungry company, right? As we've demonstrated in the past. But keeping that aside, we think that the opportunity set in rural India is quite substantial, right? And in the rural tech play that we have, we're obviously dovetailing our credit business also on the back of the same rural tech play. So I think it's quite interesting. We think there are a couple of good things that we like about this model. Firstly, I think there is a significant focus on creating a fee income line of business rather than an interest line of business, right? So the entire rural tech business, if you think, majority of income we make out there is all fee income, right? Which are commissions, throughput based, and they're more annuity-driven fee income constructs, right? Which I think are predictable and therefore interesting to look at. Secondly, the market opportunity is quite substantial, as I made the point earlier, and is growing quite rapidly. So our opportunity set out there, just focusing on that materially is important. And as long as we are able to, keep expanding our network, keep increasing our throughputs, keep increasing our product set, we think it can be a significant game changer for us. Credit will continue to be a platform. We have the balance sheet, and therefore it will come in, but it will be more focused on helping our players or our partners who are on our platform for giving them credit. Again, driven by 2-3 thoughts. One, obviously, when someone is on our platform, we have, proprietary transaction data, which helps us improve our underwriting capabilities. Number 2, because we have throughputs going through, we are also able to manage our collection costs quite interestingly. And number 3, your acquisition costs are pretty minimal, right? Because these are customers which are sitting inside the door. So if you can manage your acquisition costs, if you can manage your collection costs, and if our underwriting model is better, we think that's the right way to build a credit business. And if the opportunity set of the underlying retailers is quite substantial, I mean, there are, you can read various reports and different people will tell you different numbers, but there are 70 million retailers out there in rural India that potentially could all become, partners. So the opportunity is quite huge. So we are trying to dovetail and put everything together in a risk-managed model whereby we can try and create a sustainable business.
Okay, that makes sense. And then, so, when you talk about M&A, shouldn't your M&A strategy be just focused on rural tech rather than other areas as well? For the simple reason what you said, that the market opportunity is huge and your GTV is also very high in that segment. So
absolutely. I mean, there is clearly a lot of focus on scaling up the rural tech platform, right? No question about it. And there are M&A opportunities which will come there. I would suspect that more opportunities on the M&A side will come for expanding distribution faster, which again is interesting from our point of view. On the product stack, again, we need to see what price we want to pay, because there'll always be the buy versus build question that we need to think through, because we are a tech company, we can build a lot of the product capabilities ourselves, so we will keep evaluating that. The reason that we keep the window open for the other options as well is there could be interesting propositions that could come. Either one could look at getting into a platform that could do procurement. It could be interesting for us. So it's a wide range of things that we are exploring right now. But clearly, looking at M&A on the rural side is clearly one focus area that we have, for sure.
Right. I have more questions, but I think I will get back in the queue and let other people ask. Yeah. Thanks.
Sure.
Thank you. The next question is from the line of Mehul Parekh from SVS Securities. Please go ahead. Mr. Parekh, please go ahead with your question. Your line is in talk mode.
Yeah. So, hello, sir. I just wanted to understand from the wealth tech piece, in terms of the product line, about the products which you are at the moment selling on the wealth platform. I understand you have this micro insurance, which at the moment you are selling. But do you have any plans of other products that you want to put it on the platform for the retailers? For the rural people, and to an understanding of how the rural people get to understand as per their risk appetite, what is the kind of the product that they can choose on the platform. So what I wanted to understand is that the retailers who have this particular platform, how much they push this particular products to the rural people, or what is the kind of trying to get the matching done at the point of buying the product.
So, firstly, on the wealth side, the wealth business is largely urban-centric and urban-dominated, so it is part of our urban tech platform. Although there is, over time, there is going to be opportunity on the wealth side in the rural India, but right now in the rural platform, the objective is to offer them and deliver them the basic banking services, which is a big product market gap there. Secondly, on the wealth tech products itself, we have a reasonably wide product stack ranging from mutual funds, equity mutual funds, debt mutual funds, bonds, some of our partnerships with for fixed deposits, etc. So it's a reasonably wide product stack on the wealth side. And I think your second question on what is sold to the retailers in the rural tech platform, it is largely basic banking services. Okay. And as we have discussed, these include some of the payment products, which is cash to digital, digital to cash, and now even digital to digital.
Okay, sir. Thank you, sir. So my second question is, you talked about designing your credit underwriting tool in terms of disbursing the credit to the retailers based on the transaction. Do you feel that the kind of the information that is available on the platform or in this ecosystem is completely 100% fine, or do you need more information to get to make your algorithm or your tool become more specific for this particular underwriting process?
Yeah, so I think, you see, underwriting is, in my view, an art, right? We keep perfecting it, right? It comes with numbers, so people think it's science. I think underwriting is an art. One needs to be able to look through the numbers to see what's going on. So it's not only the transaction data. Transaction data is a unique set of data that we have access to for our retailers. but we also look at other data points in terms of their financials, etc., to arrive at how much loan to give, what to give, and what tenor to give, right? And what is the end use of that capital. So it's like I said, it's a triangulation of multiple pieces of data. We think that the information that we get from the transaction data gives us the most insight into then making a well-informed judgment about the credit worthiness of the person we are dealing with.
So if I have to understand, like, the amount of the accounts or the bank accounts or the retailer would have, do you anticipate that you would be covering at least 80 to 90% of it while doing the analysis?
So we would cover a pretty significant portion of it, but you should realize that what happens with our transaction data is the retailers who are working with us, and as mentioned in my talk earlier as well, that we focus on income augmentation. So our retailers are making money through us on the payments that get routed through their network. So we have a pretty good handle on what income they're making from us, and dovetailing that data into trying to use that to identify how much credit worthiness the customer has, I think becomes relatively easier, because you've got an income stream that you can depend on, and you're pretty sure that that is a genuine income stream. So that matters, and then obviously you use that, look at other liabilities, etc., that the customer may have to make sure that you are able to provide that. Now, it's not only about using that information. The second thing which I think is important from a credit standpoint is to also see how you can keep control of the cash. So the fact that we have wallets of these retailers sitting with us, we are able to use those wallets to either disburse the money or take the EMIs from there, just gives us an incremental benefit, which may or may not be available to other players.
Thank you. Mr. Parekh, sorry to interrupt you. May we request that you return to the question queue for follow-up questions? Thank you. The next question is from the line of Nitin Gandhi from KIFS Trade Capital. Please go ahead. Mr. Gandhi, please go ahead with your question. Your line is in talk mode. Mr. Nitin Gandhi, please go ahead with your question.
Yeah. Hi, thanks for opportunity. I have basically three questions. I wish, can you share something on your personnel cost, which is amongst these three verticals, and with the team getting built, how are they likely to play with the key team which you have with ESOP's plan, and what are their performance criteria for next 1 or 2 years?
Okay. You want to complete your question, or should I just answer this to start with? Okay, let me answer this, right? So yeah. Clearly, I think the personnel exact cost, I think Romit can give from the numbers. But more importantly, I think we have a pretty tried and tested mechanism for goal setting and appraisals, which is how we value our people. We've been beefing up our team. We have a new CTO. We had announced that to the exchange a couple of weeks ago. We've got a new CMO, which is Chief Marketing Officer, across all our subsidiaries. So we are beefing up our organization with getting the right talent into the company, and we will continue to do that. As I mentioned in my talk, I think as we expand, as we scale, we need to increase the bandwidth of people that we have, and therefore we need to keep increasing, and that will continue to be the focus for us of getting good talent as we expand both our networks and our product stack. On the technology side, clearly we have a pretty significant number of people that are focused, right? I think at last count we were almost about 85 to 90 people that are singularly focused on helping with our technology build. So that continues to be a focus area. With the new CTPO coming in, we are pretty excited about all that he brings on the table to help us improve the quality of our technology and the product stack that we can bring on the table for our customers. The fact is that our employees are given stock options, so if you see the stock option charge, because we think it creates great alignment with business results and with the shareholder interest. And I think that will continue to be our focus area on how we reward our employees, and that will continue to be there.
So in terms of numbers, I think the numbers are there in the results. So 187.3 million was the total consolidated employee cost, and we call out the ESOP charge separately. So roughly that is at about between 18 to 20%. And the charge on the ESOP is basically a function of the option value that is calculated, which obviously gets impacted by the vols. So if the vols are high, the charges are higher. But suffice to say, it's been at about 18 to 20% of the aggregate employee cost.
Yeah, thanks for this. But what I was looking for was like some key deliverables from vertical heads, and is that likely to be spanned increasing significantly from whatever 20 crores to say 30 crores or 40 crores, something like in 1 or 2 years? Or are we saying that, okay, the reasonable top model is there, now the mid and lower will be stacked up, so correspondingly the charge will be gradually lower? That's what I was trying to understand.
So I think all the businesses have their business targets, right? They have their goals. The goals are both qualitative and quantitative. I don't know if that answers your question, because the details of that, it's difficult to share because every business is different, right? So the rural tech business has its own set of goals, targets, reward schemes, etc., which is across the organization. Similarly for the web tech, and similarly for our urban tech franchise.
Yeah, so what I was trying to understand is that how do we monitor sitting out that, okay, in terms of the reach or in terms of the coverage or in terms of number of or credit size of the portfolio built coming from the legacy book, and you have 100 plus or 155 already sitting, which is earning treasury yield lower side. So if that is deployed, what could be the benefits? Something like on those grounds.
Yes, sir. Look, I think in terms of metrics, obviously we have a detailed metric on which all the businesses are tracked, and all the business and the team is tracked on. So I think that tracking and mapping is obviously we have a pretty detailed dashboard with the management, right? So all of that is obviously taken care of in terms of how we track and run the business.
Thank you. Mr. Gandhi, may we request that you return to the question queue for follow-up questions? Thank you. The next question is from the line of Bhavik Mehta from Root Ventures. Please go ahead.
Yeah. So 2 questions. First is, given in the previous participant, you mentioned that wealth tech currently is primarily lower than 5% of the revenue. Just trying to understand what exactly went wrong with the wealth tech piece. Given the past 3-4 years, it has been a great stage for, at least in India, and various other fintech players have capitalized that really well. And given the peers that you mentioned on your pitch deck as well, so all have grown. Is that because there was no separate acquisition model, or were you too averse on acquiring new clients with the cost? Or what exactly is the reason for that?
So I don't know if I would agree with your assessment, because wealth tech has actually done quite well for us in terms of just the scale up that we wanted, right? Now it's a competitive market. The point is that we started from pretty much a negligible amount of AUM, right? And today we are last year itself we've expanded AUM by 31%. The footprint of the business, it's a homegrown digital business that we acquired, which is really at the forefront of adding new products, and there are a couple of interesting products we added last year. One critical one of that being providing a SaaS-based analytics solution, which we hope to scale up in the coming years. So there are some very interesting things we are doing, which are again very differentiated. So if I look at the growth of the AUM, I think it's been quite good from our point of view. We've just expanded the entire wealth platform to our entire urban tech network by offering even white label solutions to our chartered accountant community. So there's a lot of work that's happening out there. The translation of all this activity into revenues will take a little time, which is why today the contribution seems negligible in the overall bottom line. But I think the business continues to scale, and as long as we can keep getting our footprint to expand in terms of increased AUM and increased client base, I think we will continue to do that. Plus, I think the investments required in this business are quite minimal. All the investments are all done. So at the margin, there is not significant level of investments that are being done on the WealthTech platform. This is a time for us to just expand the network, expand the footprint. The product addition is anyway happening.
And just one point to add on the WealthTech piece is that the mix is looking low because obviously a payment-led or a transaction-led business model obviously scales up faster and has a dominant share. However, if I look at the revenue growth of the WealthTech business, the revenue growth of the WealthTech business for FY21 has been ahead of the company average.
Thank you. Ladies and gentlemen, we will take the last question from the line of VP Rajesh from Banyan Capital. Please go ahead.
Yeah, hi. Thanks, Salim. So if I look at your rural tech business, right, it did about 13 crores in Q4, right, based on what you said. So can you just share what would have been the gross profit on that particular vertical?
So the margins, I mean, if you look at that business, we've not split out the margins, Rajesh, for each of our businesses. But you can actually very well back calculate the margins from that business, right, from console versus standalone. The only, if you're looking at 4Q to back calculate the margins, the only comment I have there is that there were certain additional excess fee income that we generated in Q4. So there might be a little bit of bump up in the margin that you may see when you back calculate it between console and standalone.
Yeah, no, I'm just trying to understand this business a little bit better. And my question was more to understand if you're paying any third parties for any kind of access, etc. So that's why I was asking gross profit. I was not asking for contribution margin or EBITDA margin. My focus was on gross profit.
Right. So I think if you look at the participants, right, typically the participants in a typical transaction value chain are the bank, us, and the retailers, right? The BC partners and retailers. So the banks typically have the lowest share because it is more a regulatory requirement for us to route the transactions through the bank. So that share is a minimal, and bulk of the share is with the retailer and the partner. So banks are the lowest in the value chain. Retailer, obviously, because he's the front, he's the storefront, is the highest, and we are somewhere in between.
Right. Okay, I'll take it up offline. Thank you.
Yeah, thanks.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Tashwinder Singh, CEO, for closing comments.
Thank you all for taking the time to listen to us and our story. I sincerely hope that you will continue to track us. If you have further questions, feel free to reach out to Rumit or to me. You can drop us an email on the numbers or on the business strategy. We are very happy to engage and clarify all questions. Stay safe, everyone. We hope that we get out of this pandemic sooner rather than later and get back to our businesses as usual. Thank you.
Thank you. Ladies and gentlemen, on behalf of Niyogin Fintech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.